Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Today, I'm going to talk about the historic gains we saw this week in markets and what they may or may not tell us. It's Friday, April 11th at 2 p.m. in London. Wednesday saw the S&P 500 gain 9.5%. It was the 10th best day for the U.S. equity market in the last century, which raises a reasonable question. Is that a good thing? Do large one-day gains suggest further strength ahead, or something else? This is the type of research question we love digging into. Pulling together the data, it's pretty straightforward to sort through those other banner days in stock market history going back to 1925. And what they show is notable. I'm now going to read to you when those large gains occurred, in order of the gains themselves. The best day in market history, March 15th, 1933, when stocks soared over 16%, it happened during the Great Depression. The second best day, October 30th, 1929, during the Great Depression. The third best day, Great Depression. The fourth best, the first trading day after Germany invaded Poland in 1939 and World War II began. The fifth best day, Great Depression. The sixth best, October 2008, during the financial crisis. The seventh best, also during the financial crisis. The eighth best, the Great Depression again. The ninth best, the Great Depression. And the 10th best, well, that was Wednesday. We are in interesting company, to say the least. Incidentally, we stop here in the interest of brevity. This is a podcast known for being sharp and to the point. But if we kept moving further down the list, the next best 20 days in history all happened during either COVID, the 1987 crash, a recession, or a depression. So why would that be? Why, factually, have some of the best days in market history occurred during some of the very worst of possible backdrops? In some cases, it really was a sign of a buying opportunity. As terrible as the Great Depression was, and as the grandson of a South Dakota farmer, I heard the tales, stocks were very cheap at the time, and there were some very large rallies in 1932, 1933, or even 1929. During COVID, the gains of March 24th of 2020, which were associated with major stimulus, represented the major market low. But it can also be the case that during difficult environments, investors are cautious, and they're ultimately right to be cautious. But because of that fear, any good news, any spark of hope can cause an outsized reaction. But it also sometimes doesn't change that overall challenging picture and then reverses. Those two large rallies that happened in October of 2008 during the global financial crisis, well, they both happened around hopes for government and central bank support. And that temporarily lifted the market. But it didn't shift the overall picture. What does this mean for investors? On average, markets are roughly unchanged in the 3 months following some of these largest historical gains. But the range of what happens next is very wide. It is a sign, we think, that these are not normal times, and that the range of outcomes, unfortunately, has become larger. Thanks for listening. If you enjoyed the show, leave us a review wherever you listen, and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.